Good morning. It's 10 o'clock in the morning and I'm going through my notebook here. And going through my notebook, I already have been asked 4 questions by accountants that I don't know the answer to. Now, I've spent the last 17 years, and my main focus for the entire time since we founded OmniPro is answering questions for accountants. Yet this morning I have 4 that I'm going to have to pass over to our technical team to get the answers for. And it never ceases to amaze me how the questions can keep coming, the issues can keep arising, the problems can keep coming up. And you know, it's like one of the accountants said to me this morning. They said, Des, look, I could possibly answer this question myself, but I just don't have the time, the capacity. And even if I answered it myself, how would I know whether I'm right or not? And John is joining me here this morning, and John has a question that has come into KnowledgeHUB in the last couple of weeks. Now, some of you will say, well, okay, this sounds like a very basic question, but this is a prime example of the nuances and prime example of where people are missing stuff. So, there's different ways you can do it, but the people are sometimes making mistakes here.
Yeah. So effectively the question that comes up, regularly enough in relation to, well, look, I'm transferring a business in, I obviously when you transfer a business, as part of that, you're more than likely transferring plant and machinery where you've had capital allowances in which you've claimed on it. So technically, if on the transfer of those plant and machinery, let's say into a company, if you are incorporating, and this section applies whether you're incorporated or not. On the transfer, what section 312(3) of the legislation says that on a transfer to, let's say, a company that you control, in that particular case, it's deemed to be transferred for market value. So effectively what that could mean for some entities is that this would result in a balancing charge being applied for income tax purposes, which is obviously not where you want to get to. Our section 312(5) effectively, and section 312(3) applies where the transfer is transferred other than for market value. What section 3125 says, well, we won't say it's done for market value effectively if both parties of the transaction elect for it to be transferred at tax written down value. So what's that mean practically? It means on the transfer, both parties to elect, it means that, there's deemed to be no balancing charge here because you're selling it for exactly equal to tax written down value. And the person that takes it over, let's say if it's a company, the company will take it over and claim the remaining allowances at that point in time. What this is very beneficial for is, let's say, potentially for businesses that have plant and machinery, so the likes of farmers, maybe the likes of plant businesses, things like that, where the machinery holds their value very well. So I suppose there's a little trick in the legislation here, in that, technically, if you're transferring that, let's say, through a director's current account, ordinarily we'd say it'd be market value and you have balancing charge here. But if you elect under section 312(5) to transfer that tax written down value, but actually charge let's say if it's company, charge the company anything less than market value, well, then you'll be able to create a director's current account for a higher amount. So it's one that's a little glitch in the legislation. I do foresee it. Maybe it will be changed in time. But one thing you need to be careful about if you are doing that trick, because a lot of farmers or plant people are incorporating, and they're trying to avoid the balancing charge here, try and get in a big director's current account. But you need to be very careful because section 312 only applies where it's transferred for an amount other than at market value. So if you transfer, let's say, a piece of plant and machinery, let's say you transferred in through director's current account, you get a market value of the plant and machinery, and the market value is 100,000. If you transfer it in, let's say the tax written down value is 40,000, you make your election to transfer it into the company, create a director's own account for 100,000, and you elect to transfer a tax written down value. The problem there is, in my reading of legislation, is section 312 is no application there because you've sold it for market value, and section 312 only comes into play where you've sold it for anything other than market value. So if you are going to do that, you need to be careful that you sell it for less than market value. And I suppose when you're selling it for less than market value there, you need to make sure that it's enough that revenue can't challenge that it is market value. So I'd always say have a market valuation done on whatever plant machinery is coming in relation to it, and make sure the price that you put in that in your director's current account is enough different for revenue not to be able to challenge that it was market value, because they can challenge it was market value, but then they can say you can't make the election under section 312 to have a transfer tax written down value. Give us the income tax, and we'll have the balancing charge on that in your income tax return. So that's the little trick and the nuance, just to be aware of that.
Yeah, so the bottom line here, John, is and correct me now if I'm getting this understanding wrong, but I'm not a tax expert like yourself. So we've got somebody who is incorporating, and they have plant and machinery or equipment, and if they get the market value, they can transfer at below the market value and create a director's current account in the company. Where does the tax written down value come into it, John? Because obviously we need to be below the market value.
Is an election, and so for tax purposes purely, when you put your additions into your capital allowance schedule, you will put in just the amount of tax written down value. So my example would be 40,000, and you'd only claim that. So technically, on a future sale, you're technically on, if you were to sell it the next day, you would have a balancing charge. But the idea is you wouldn't be selling necessarily the next day, because you'll keep on to it for a while. So that's it. That's just the risk is, people are selling it in. People mightn't be aware of it, but if they are aware, they might be selling it in for market value, which technically can be pulled up by revenue, because my written legislation is, well, then you're not into section 312 at all, and you can't make tax written down value election. I suppose the other thing to remember here is that, capital assets in which capital allowances are claimed are chargeable are chargeable assets for capital gains tax purposes. But in most of the situations, like under 560, section 560 of the legislation deals with wasting assets, but it says for an asset which is a wasting asset is an asset of less than 50 years. For such an asset which is used for purpose of the trade and capital allowance are claimed, for the purpose of CGT, it's not a wasting asset, and instead the base cost is equal to your cost. So in most of these situations, you wouldn't be selling it for more than what you originally bought it for. If you were, you might have CGT exposure, but it's unlikely in those cases. Even let's say agricultural machinery, you never want to sell it for more than what you originally purchased it for. More than likely, just to be conscious of that as well. So CGT comes into play, and you just need to watch it. If it was more than cost, it would be very unlikely to be more than cost.
I'm a huge fan of simplicity, John, but it just never ceases to amaze me how something so seemingly innocuous and simple on the surface, like incorporation of machinery, the depth of where the threads go within the tax legislation.
And I suppose, revenue might necessarily like it. So I do think it will be closing. They'll try and close this hole. I just am aware of cases where they've been looking at and they've kind of been questioned, but they haven't been able to get any money out of it when they come in to have a look at it. So just beware. The other thing while we're on this topic is just if we're talking about farmers, I hear some farmers that transfer in the stock at market value, put your director's current account, and then claim section 89 to allow it to be, or section 89 or section 656 to be allowed to be brought in for tax purposes at book value. I don't agree that that's possible. I think you're in an aggressive situation if you're doing that, if you're transferring to a director's current account in relation to that. So just to watch that, and I suppose if you are doing that, just to be very wary, because it could be pulled up by revenue. I don't see that it works, but I know some people do.
And I think that's one of the benefits of where you're sitting, John. Because say I'm an accountant in practice, I obviously have experience of what's in front of me, and I could be a very experienced tax practitioner. I could have excellent tax knowledge, but I only have experience of what's in front of me. Where you're kind of getting an overview of the entire market, John, because you literally have hundreds of accountants feeding into you what's happening in revenue audits, what you're seeing, and where these interpretations and nuances are coming from. I know, John, that you're not in any way aggressive, that you lay out the tax options and you always tell people, well, this is on the aggressive end, this is at the mid-level, this is at the safe end. But it's always helpful to understand, well, when revenue challenge something and they fall short because the legislation doesn't allow them challenge, that's a good insight, because that makes that type of an interpretation a little bit safer until the legislation is amended and adjusted.
Yeah.
Okay, so that is our 10 at 10 this morning, where John is looking at the transfer of assets on incorporation or wherever there is a transfer of trade. This is a question that's come into John through KnowledgeHUB. We have hundreds of accountants are members of KnowledgeHUB, and they're asking us questions every day. Our technical team are answering the questions. As the questions are answered, KnowledgeHUB is updated so that we're building up this massive searchable database. And we are running a webinar next week. So on Thursday of next week, the KnowledgeHUB team are coming together with me, and we're going to run a webinar where we look at some of the top questions, top issues that are being asked in the month of July. So JR has a registration link for that webinar, depending on where you're watching, but in most places, Facebook, LinkedIn, and YouTube, the registration link is up above here. So if you want to register for that free webinar and join us, we're looking at between 8 and 10 topics in that session, like the one we've covered this morning, practical things that are happening that you need to be aware of right now.
Yeah, and I suppose, Des, just to say, obviously we have more complex ones in there, but the purpose of these videos aren't necessarily going to complexities. It's kind of give a flavor in relation to it.
Yeah. And John's probably going to kill me now, but if you have any questions that you want to get answered, maybe as part of that webinar, either if you email into us, and just say KnowledgeHUB query, or if you want to put your query in the comment box below where we're watching here, and Jonathan's going to capture up all the comments, all the questions, and we may address some of your questions in our webinar next week. So the webinar next week, just to confirm the time and date here, I should really have had that checked before I came on with you. So the webinar is Thursday, the 23rd of July, and it is kicking off at 3 o'clock. It is a 90-minute webinar. So registration link above. We look forward to seeing you next week. Thanks for joining us on today's